Pricing policies, influencing factors. We are looking at the internal factors. Influencing factors. We are looking at the internal factors here, such as pricing objectives, other markets mix variables, the other three P's, the costs and risk. Internal factors, pricing objectives. It has to be consistent with the organization objectives. Example, a bank aims to be the largest provider of housing loans, so it will set a low price to achieve the volume growth and to undercut competitors' prices. Here's a good example. Undercut competitors' prices. Hong Leong Finance lowers HDB loan rates. Basically, Hong Leong Finance unveiled a HDB loan package from the lowest rates in the town. It aims to be the largest provider for housing loan by undercutting competitors' price. In fact, this is an effective strategy, okay, deployed by the banks. Other marketing mix variables. It complements other elements in the marketing mix, the services, distribution channel, and promotion. All the four components must be consistent with each other. The four components of the 4 P's of the marketing mix. Cost. Price must be determined in relation to the demand and the customer's willingness to pay. And cost cannot be ignored at all. To identify the cost of a service, we need to identify the fixed costs and variable costs on a per unit basis. Problems faced by the banks in identifying costs. Often, it is very difficult for a bank to distinguish between a fixed cost and a variable cost. For example, labor time typically is a variable cost, but it could be considered a fixed cost for permanent branch staff. Banks have a high level of fixed costs. Example, central operation, such as the credit admin departments. And an example is the other branches. To determine prices, fixed costs need to be allocated across many different services. The same service may have different costs for different customers. Example, current account of a customer A have with a large number of transactions. This will have a high cost. This basically incurs high cost for the banks compared to a current account of a customer B with few transactions. This will incur low cost to the bank. Cross subsidization. Pricing in banking has varying degrees of cross subsidization. It occurs between consumers of the same product. Low cost customer cross subsidize the high cost one. Between the sectors, the high profit personal sector tends to cross subsidize the corporate sector. A bank can lose out to its competitors who can cost and price effectively. This is important. You may have very good marketing campaign, but if you fail to process and price more effectively, you still will lose out. So a better information system can allocate costs to individual service better. So banks do invest a lot in the IT structure, okay, to allocate costs to individual service better. Okay, this is a ministerial statement on bank charges by DBS. Has Post has been losing money on small account? Yes. In fact, it's about 3.8 million out of the 5.2 million account. It's not economical. Basically, it's not making money. The bank is basically losing money. So the revenue for small accounts are less than the cost of servicing them. So Post try not to recover the part of the cost from small depositor. What it does is it cross subsidize the small depositor using the profit earned from the larger accounts. Now, the banking environment has become more open and competitive. It has become more difficult for any banks to cross subsidize small accounts in this way. Risk. Risk is affected by credit standing and the collateral. So basically, is the general rule is that if the customer pose a high risk to the bank will charge high interest rate on the customer.